All right, cool. So I'm going to kick off then. So again, thanks so much everybody for joining, and great to see you all. Today, the topic is around the whole funding story and how to fund your business, be it equity, debt, or option-based financing. So to start, I guess, what stage do you consider to raise funding, right? Is it before you launch a brand, before you have revenue, after you have revenue? And the answer is we raised money 5 months before we had our first revenue. We raised money on the back of the story: A, cannabis is a growing market; B, we're going to be the best marketplace out there; C, we were investing a lot in SEO and content, and we could show how well we rank, how well we attract kind of impressions and clicks, even before we had any revenue. So in short, there is no right or wrong time. Kind of raise, I would always say, raise when you can and raise as early as possible. And then in terms of, what do you actually show to investors? What do they want to see? So as I mentioned, they want to see a story, they want to see a credible team, and they want to see traction. So let's say, for example, you have revenue, and you want to show how fast your revenue is growing, so you can actually spend money on influencer marketing, which we, by the way, can also help you with, to show more traction and then raise on the back of that. In terms of crowdfunding versus VC versus angels, we saw a really interesting example with Voyager CBD. Going out to Cedars, looking to raise 175K, and in 4 days they raised 840K, so more than 4 times what they planned to raise. And that's an example where you as a CBD brand, and the majority of you guys are in the CBD or cannabis space here, you benefit right now from the whole hype in the market, and the hype also brings a lot of investor interest. And so crowdfunding is definitely an option. I guess the rationale to go to a VC is, yes, you can actually get more money straight away because VCs can give you your 500 or a million, but you will usually take terms which they then have a board seat, you give away equity, and so potentially you prefer, or potentially it's better to raise at an early stage from outside the VC ecosystem, from either angels or, again, if you can, from alternative funding mechanisms where you don't actually dilute yourself. And then in terms of investor types and the question, okay, are there cannabis specific investors? So yes, there are some cannabis funds out there. We have an investor called Annexus. It's a Swedish-based cannabis fund. But to be honest, this space is becoming very mainstream, so I wouldn't limit yourself only to cannabis investors. If your story is good, you can raise money also from non-cannabis investors. And ultimately, you also want to consider alternative ways to funding your business.
My name is Ben Grant. I work at MarketFinance. So a bit of background, I spent sort of 5 or 6 years at mainly very large UK-based finance institutions doing sort of commercial and strategy stuff before then moving on to do new product development, launching kind of the personal finance products at places like Direct Line Group and Churchill and stuff like that. I moved out of sort of big, horrible corporate world to MarketFinance in November, kind of looking again at new product development, except now instead of doing it to sort of the faceless general public, it's far more tailored, looking at actually what do small businesses need and what can we give them that is going to fill a bit of a gap. Lovely. So yeah, the big thing is for small businesses and especially for consumer brands is that cash is king. So the vast majority of businesses fail, especially small to medium-sized businesses fail due to issues with cash flow. It's also not only the impact it has on the business, but those people that run the business. So 41% of owners say that cash flow is their biggest challenge. And generally the other 59% have a CFO, and for them, cash flow is their biggest challenge. It is generally sort of you win or lose by your cash flow figure. A lot of this is obviously driven by invoices being paid late. That is the number one reason why businesses tend to get into cash flow issues, is simply because they're waiting for money to come in, but they've already paid the money out, and there's kind of that horrible period of time where everything's on the wrong side of the dial. So, it's a big thing that we go through with a lot of customers at Market Finance, and kind of a lot of our partners' customers, is that it's always working capital is the big concern. It's always working capital. The interesting thing is the difference between cash flow and profitability. So you can be unprofitable or non-profitable or operate at a loss almost indefinitely if you have sufficient cash to kind of keep you topped up. So Tesla is a great example. Obviously, it's an incredibly popular company and vast market cap, but they had their first year of profitability in 2020. However, because of all to an extent, the hype, the IPO, the investment they had, they were able to mask years of unprofitability. The unit economics on something like a Model S or a Model X, they're wholly loss-leading products, while they took the time to do the research to get them to a point where actually the business is profitable, the business actually makes money. So that's kind of the one end of the extreme. The other end of the extreme is you can have incredibly successful sort of theoretical businesses where the unit economics make total sense, the distribution channels are good and all that sort of thing. But if that business doesn't have enough cash, if it doesn't have the working capital, the business will almost certainly fail unless they can find a way to bridge the gap or keep their reserves topped up. So obviously the most obvious cash flow funding option is retained profit. So retained profit simply being, when you buy for X, you sell for X plus one, you keep plus one in the bank, and you start again. It's great because it is free, so there is no interest charge, there's no fees. That money is completely organic. If the product is scalable, then hopefully that money will incrementally increase, and you'll build up this kind of cash buffer that can be used to mend any working capital issues. But it's not without cons. Number one is it's not always an option. Again, if you're trying to fuel growth, then you're going to need to have sort of a growing amount of cash on hand. The second one is it's not always enough. So you may well have great unit economics, you may make money, you may be able to squirrel some of it away. But actually, if you're pushing for growth, if you're pushing for expansion, you want to develop a new product line, or you want to enter a new market, quite often that amount of cash is just not going to be enough to do so. And then the third thing is the opportunity cost. So if if every little bit of profit you take, you squirrel away for a rainy day, in case your buyers don't come through on an invoice, if you're squirreling all that money away, you're missing the opportunity for growth. You're missing the opportunity to increase your marketing costs. You're essentially, the opportunity cost there can often really outstrip the benefit. A second option, which kind of Alexej's already briefly spoken about, is equity investment. So again, praise of equity investment, it's free, kind of, in the sense of that you don't sort of directly pay for the capital that you are given, or say that you earn. Also great because it comes with a lump sum, so you will get that cash injection often that you need. And often you're not just getting investment, you're getting a bit of an infrastructure. So if it is from an institutional house, so if you're going venture capital or things get a bit bigger, private equity, you're going to get that advice, you're going to get people on the board, basically other people that want you to win. Probably not quite as much as you yourself want to win, but they've got skin in the game. They're going to do what they can to help grow the business because your interests are aligned. So the con, straight off the bat, is it's not always an option. Again, you need to have a compelling story for investors. Again, Alexej's probably a much better person to talk to this than I am, but it's not always the best option, or it's not even on the table sometimes. The other issue is it can be very time consuming. So, this is not something that you can apply for on Monday and you'll have it through by Friday. It is very much a process. And obviously the more you want to raise, the more complicated things get. And actually there is, to an extent, an expense that is incurred at that point. So there's plenty of legal stuff, there's plenty of tax implications, there's all that sort of thing that has to be factored in as well. Third one, can't really be done that regularly. Unless you're really hot in demand, it's quite difficult to just raise endless rounds of financing. And you often don't want to. There's no point diluting your equity pool, just because you need a bit more cash or you want to develop a new product line. There are other facilities for that. And then the last one, obviously, is caveats. You're giving away board seats, you're giving away equity, you are losing control. So it's not always the best way forward. First one, easiest, credit cards, overdrafts. Again, pros can be great, can be free. So often you clear a credit card by the end of the month, you don't pay interest on that debt. Again, you'd have to shop around for it, but often there's balance transfer cards that give you 12 months, 0% finance. These are, when used correctly, great facilities, and do actually offer what is almost impossible to offer, which is access to free capital. They're also very quick. So making a card payment is as easy as making a card payment. Applying for a credit card is a very refined customer journey. It's an easy thing to do. That said, the cons are quite extensive. So it is quite easy to lose track, and it can get out of hand. The interesting thing about credit cards is credit cards are designed to make money off of people making mistakes. So there is no such thing truly as free capital. So that's why when you go over on your credit card, immediately you're into fees. And not only are you into fees, you're then into compounded fees and compounded debt. So a poorly managed credit card is essentially just a recipe for disaster. It is shooting the hole in the bottom of the boat. It can get itself really out of hand. And so you have to be very careful when you're using them. Next one, obviously, that's very popular is just a straight up loan. Very popular at the moment because of CBILS. So CBILS is the Corona Business Interruption Loan Scheme. It's a government-backed scheme. Essentially, the government has waded in, given the current crisis that we're in, and helped to shore up a lot of the debt. This means that companies such as MarketFinance, but also obviously other companies in the market, are able to offer much more competitive interest rates. In many cases, there's no interest to be paid for the first 12 months. And it's kind of as good as or as cheap as debt has been in recent times. For a lot of businesses, it's been quite compelling. Also gives access to larger sums of money. So you can have up to 2.5 million. Again, the amount of money that will be lent is based on the business. You can't just sort of apply for 2.5 million and expect to get it. It will obviously require a degree of proof and a degree of eligibility. The great thing about sort of taking out a lump loan or what we call a term loan, so maybe a 1 year, 2 year, 3 year, 4 year, 5 year term, is it's very predictable. You know exactly what you're going to be paying out every month for the next 60 months. You know exactly what that debt's going to cost you. And so it can be baked into all of your accounts. So when you're doing cash flow forecasts or anything like that, sorting your balance sheet out at the end of the year, you will know exactly what your obligations are for the debt that you have. It's also great because it's versatile. You are given a lump sum of money. You can do with that whatever essentially you wish. You know, if your needs change halfway through a term and you still have some of the loan left, it's great. You're not bound to anything with that debt. You're free to explore different avenues, different products, different strategies. You've essentially got this sort of big lump of cash to exercise as you see fit. Cons is it's kind of easy to get the number wrong. Often people take out too much or they take out too little, and it's quite hard finding that Goldilocks point. Especially when you're looking over sort of a span of years, 2-3 years. How actually do you know how much capital you're going to need for your development over that amount of time? In the same vein, it can be a bit inflexible. So depending again who your provider is, it's worth doing the research. There's often there can be fees for getting out of loans early. There can be fees for early repayment. Some loans they're hard to extend. You can't top them up. So you end up kind of tied to a facility, and you might then end up having to get additional things to top it up. And it's not quite exactly what you need it to be all the time. This one is invoice financing. So this is MarketFinance's sort of speciality. Invoice financing is, for those of you who aren't kind of familiar with the product, if you are, let's say as a CBD brand, you are selling a nice big healthy chunk of stock to a wholesaler. You submit an invoice to them. They go, that's wonderful. Thanks so much. We'll pay you for that in 60 days. And that's great. You've got a nice big contract. The problem is you've now got 60 days to wait to get paid. Invoice financing is essentially you take that invoice, which is kind of like a mini bearer bond. It's evidence of value. And you go to someone like MarketFinance, you say, I've got an invoice for £10,000. I want to unlock some of the money early. So like MarketFinance will look at the invoice and go, okay, potentially that looks good. We will give you 85% of the money now up front. And then when that invoice is successfully paid by the wholesaler to you, when they transfer the funds, we'll take the other 50, we'll pay you the other 15% and you kind of go off on your merry way. It's really great because you can toggle it on and off. It's quite affordable because of that. There's no fixed cost attached to it. And you are getting kind of that, hopefully that 85+% upfront. There are some cons to it. It's generally it can be sort of a relatively extensive process. You need to kind of get your suppliers and your customers involved in it. And there's a degree of paperwork to be done, which means it is ideally done with bigger orders. It kind of means that often people don't want to do it with every single order. The other issue is if you're issuing the invoice and for any reason the person you're buying, who's buying your goods, doesn't pay up, you are still responsible for the debt. So it can have its fallbacks on those couple of points. Another option, revolving credit facility. It is great because it's very flexible. Revolving credit facility, again, is kind of like it's almost like a giant cash credit overdraft style thing. It's sort of you get pre-approved for a line of credit, and you're then able to draw down and repay that credit. So if you wanted to, say you had you were given a £100,000 facility, you could draw down £30,000 of that over 30 days, gets to the next month, draw down another £60,000. And as you pay that money back, you're able to then reuse that money. So it's kind of, it's sort of very much a very fluid product. You always have access to a certain amount of capital, but you don't have to take it all at once. You don't even have to take it kind of in an even way. You can very much access it as and when you need to. Cons on that, there's some good deals going around at the moment because of CBILS, but CBILS applications need to be in by the end of March. Again, stuff like this is interesting. It's very much worth doing a bit of research on it. The guys at MarketFinance will be more than happy to tell you everything you need to know, and kind of there's plenty out there. Finally, is the product that we're working on at the moment that'd be good to get some thoughts on that might be of use to some of you guys. Essentially, the product we're building is called MarketPay. So the product works if you imagine yourself on the left-hand side as the CBD brand. Currently, at the moment, you purchase goods off of your suppliers. They'll send you, the raw materials that you need or the products that you need. You've got maybe 15 days, 30 days to pay back your supplier. Often, smaller guys, you might have to pay pro forma or upfront, which is not great because you want to try and sell. In an ideal world, you'd have sold at least some of what you've bought before you have to pay for it. Again, just from a cash flow point of view, it's better to pay your supplier with your customers' money than your own. If you can make that a straight shot through, you're in a better place. So often at the moment, the terms that we see being extended to businesses aren't great. They don't provide that kind of time buffer for customers for companies to get the value out of the goods that they bought. The idea with MarketPay is that we are able to sort of package up a set of payment terms. So we'll put together a sort of a payments package, so like a 90-day payment term package for you, and you're able to go and take that money. We pay suppliers up front, so we pay them on day one, and then from there on, sort of a CBD brand or a buying brand are able to pay us back over 90 days. A couple of advantages we found for this is that often brands are able to get cash discounts from suppliers. So if your supplier is currently offering you 14 days or 30 days, actually if you go to them and say, we'll pay you on day one the full order value, but we want a 2% discount, 5% discount. The research we found sort of is like 2/3 of companies think they'll be able to get discounts from doing it that way. The good thing about MarketPay is it's kind of very flexible in that sense. You once you've got it set up, there's no one that we kind of can't pay. We just do some very basic checks on them, and then we make the payment straight to them. best off if you tell them that it's coming from a slightly different bank account than they're used to. So it'll come from us, obviously, but it will then have sort of your company and invoice number as the subject heading. But it generally speaking, there's no detriment to the supplier. If you're lucky, the supplier will see it and they'll like it, and then hopefully they'll start using it to give you better payment terms. So yeah, this is how it can be useful. So as we said, suppliers like it because they get paid up front. They don't have to deal with payment terms anymore. And it's great potentially for CBD brand because, you know, if you can not have to pay for the goods that you're selling until they're sold, that's the best place to be in. But yeah, is there any questions from anyone about kind of anything that we've just discussed?
We have a question from Richard North on what is the rough cost for accessing MarketPay?
Yeah, so the cost is risk-based. Generally speaking, we're seeing most companies get between sort of 1.5% and 3.5% per 30-day chunk. But it's kind of based on, it's very much on risk. The more we can know about a company, the better the rates that we can offer are. So we're trying to get any of our pilot customers at the moment to give us as much information as they can.
Sounds like supply chain finance. Is the invoice assigned to MarketPay as the third party?
Yeah, so interesting. It's a good comparison. So there are a couple of differences. So again, supply chain finance is very much a sort of finance product. It's quite difficult to apply for. It's quite process driven. There's a lot of moving parts to it. The idea behind MarketPay is it's far more of a transactional product. So this is kind of something we want to see people using at a checkout stage. Instead of reaching for your bank card or you know, putting on a credit card, we want you to use MarketPay. In a similar way that when you buy off ASOS or a consumer brand, you go and you use Klarna, and it doesn't feel like you've taken out a loan. You have taken out a loan, but as far as you're concerned, I've just paid. That's more the relationship we want. So in that sense, we want it to be different from supply chain finance in terms of ease, slickness, lack of friction, all those good things. And a key part of that is we do not take assignment of the invoice. The debt is unsecured, which again cleans up a lot of the process, tidies up a lot of the process. We don't have, there's obviously things around delivery risk and you know, our underwriting has to deal with those challenges. But ultimately the debt that we issue is unsecured, and it's unsecured against the person who is going to be paying it back.
Mm-hmm. Could you maybe outline the documents or the information a brand has to submit to get a MarketPay loan?
Yeah, absolutely. So to begin with, again, so we're currently at a piloting stage, so things are a little clunkier than we'd like them to be. To begin with, it's a pretty simple form, so it's about 5 questions. Generally speaking, it will be name of the company, director's name, director's home address, amount to be borrowed, which will, with any luck, tie up nicely to the invoice amount, and that's it to begin with. That lets us do some basic eligibility checks, and you also consent to doing a credit check at that point. We may then ask for some extra details. You know, often giving us more information will get a better rate or a higher limit. So if you can do stuff like send bank statements, that's perfect. And then potentially, in some cases, we will ask for personal guarantees, as we mentioned earlier. With smaller brands, often it's a great way of sorting out sort of good, promising companies from, you know, often, you know, that space gets a bad rep because of fraud. People start companies to expressly take out debt to then close the companies, and they've taken the money. So personal guarantees really help often in the much smaller space.
And then there's another question here. Is MarketPay geared towards B2B, or can it work with D2C where invoice volumes suggest lower risk at scale?
You're going to have to define, is that D2C or B2C? I'm wondering if that's distributed to somewhere, which I don't know where it is.
No, so D2C is basically the same as B2C.
Direct to consumer, cool. No, so it's B2B only. So the idea is that, you know, if you yourself are, it can be used both ways, potentially by a CBD brand. So if you are if you're a brand and you are purchasing off your suppliers, so maybe you're purchasing, you know, bottles, labels, the fluid itself, or the, you know, whatever it is that you makes up your product, you can use MarketPay to pay for those goods. And again, if you're then now the supplier, and you're potentially selling to wholesalers or independent retailers, or even marketplaces, or however it is that you get your product to intermediaries, you can then use MarketPay to offer terms to your customers. But at checkout, for the individual, for the consumer user, that's where you need to look at the likes of kind of Affirm, Afterpay. There's plenty of the B2C guys if that's of interest, but MarketPay can't be used there. It is a business to business solution.
Mm-hmm. Mm-hmm.
Yeah, I think there's a question regarding what are your opinion on the funding options for the THC companies in the UK? It's a bit of an interesting one for Alexej.
Yeah, I guess here maybe to add in the medical space, right? So again, then it would be a legit company as well. Yeah.
Mm-hmm.
So in Germany, you actually have two of the larger importers, distributors, receiving bank financing from larger banks because again, it is a legal business, and therefore, if the credit risk is low, then a bank can also lend even if you have THC products, as long as it's medical and it's legal. In the UK, I don't think there are any companies out there who have, let's say, who would pass any, let's say, credit risk check to get financing and debt financing, even if they would be doing CBD, for example, just because the four medical cannabis companies I know of are still very, very small. But in theory, they could get debt funding as well. And they could probably, if they show revenues and cash flow, also go to MarketFinance and ask for MarketPay product there. And I guess maybe I missed this. How does this model rely on the company liability instead of the director? It seems like if the debt was to default, the director would still be liable. Ben, last question.
Yeah, absolutely. So kind of in the UK, when a company is dissolved or goes into liquidation and bankruptcy, that company kind of enters a weird sort of receivership administration sort of status. At that point, the assets of the business are sort of surrendered, so to speak, to the creditors. At that point, it is the assets of the business that are to be distributed. So if you work for a company, the company goes under, generally speaking, that debt is not held by the individual employees, the individual shareholders, or the individual directors. The debt is held, like the assets are held, by the business at the discretion of the business. It's different with sole traders. It can be different with partnerships. It is kind of dependent on your company structure. But by and large, if you have a limited company, limited in that stands for limited liability. The whole point is that there is a degree of separation between the status of the company and the status of the people that own the company.
Yeah, I think we will probably do another session similar to this one at some point again. Again, feel free to reach out either to myself, to Ben, to Aman if you have any further questions. And otherwise, wish everybody a good rest of the day and see you soon.